This is not a long bubble. This is by far 3x the longest bubble before this. In other words, this has never happened before. And the reason is every bubble in history has come in good times, like the early 1900s, which turned in the roaring 20s. When things get good long enough, investors and analysts and stuff just get all giddy. And as Irving Fisher said in 1929, the head economist there, permanent plateau of prosperity, and people start thinking that way. And that's when stocks get overvalued, and then they bubble and they crash. And then you end up in a Great Depression when all these financial assets go down and wealth is destroyed and, businesses laying out, all that sort of stuff. This has been the longest stock market run. I take out COVID because that was totally exterior and stuff. That was just came and went. We were right back at new highs. 15-year boom without a real normal recession. That has also never happened in over 200 years of the stock market's existence. So the reason for that is very simple. It was only in 2008-9 when Ben Bernanke was the Fed chairman, who studied the Great Depression in the 30s as his thesis. When he saw 2008 hit, he was thinking like me. And I was telling people, we were predicting before and after, 2008 is 1930. This is the beginning of a Great Depression, a major bubble in financial assets burst, and a demographic surge in spending peaks and turns down and slows for a long period of time. And then you have a big deflationary deleveraging of debt, detoxing of debt, and asset prices come down. And that's the difference between a long or deep recession like in the 1970s or early 80s and a depression like the 1930s, or what should have happened in 2008 to 2022-23. Now, for the first time in history, again, you got to remember the Fed was only invented in 1914, had very limited powers, wasn't expected to do anything but just, provide cushion in a short-term crisis, to keep things from just going berserk. The Fed realized, well, we got the power to fight this damn thing. And Ben Bernanke, again, studied the Great Depression. He recognized it. Anybody else would have thought it was something different. He did see it. He threw $1 trillion in the economy in 2009, thought that'd be enough. So did Mario Draghi over in Europe. No, not nearly enough, because it was a long-term crisis, and that's enough to get you through 1 year, not through 13, 14 years. So what happens? They had to keep upping the ante, printing more and more, and here we are, $27 trillion. Now, I'm the only guy that's counted this out and broadcasting it. 19 trillion of that is nonstop government, larger than average government deficits. I haven't had one surplus since 2001, And $8 trillion of money injected directly, and that's what they call money printing. Spending deficits, because they just borrow these with treasury bonds and pay them back 30 years from now or something. All of these are creating money out of nothing and injecting it into the economy. So that's how we got the greatest bubble. Every bubble in history, again, has lasted 5-6 years most. Late 24 to 29, late 99 to early 2000. That was almost 5.5 years. That's a typical how long a stock market can go crazy by itself in normal conditions in good times before the bubble gets so crazy it bursts of its own craziness. It's because of the government, the nonstop and accelerating government, and this time fiscal stimulus has been 2/3 of it, 70% I'd say, and the monetary has been 30. Now, what happened is they finally overreacted to COVID, 20 to 22. Out of that 27 trillion I'm talking about, 11 of it came in the 2 years after COVID, and that caused this 9.1% out of nowhere inflation spike. And again, I got the best inflation indicator in the world, bar none. It's workforce growth. It is the cost of incorporating new workers in the infrastructures and new technologies they bring and require early on in this, before they become productive and earn and spend all this money they're going to do. That inflation comes in the early stages when people are entering the workforce. People think that high growth causes inflation. Our best growth periods in history, from the roaring 20s to the 50s to the 90s, had low or falling inflation. So I knew that wasn't the case from the beginning. So my research, I kept digging, realized no, workforce growth, and that correlated with the biggest 70s inflation in history. And that said that inflation would come down to about 1 to 2% in the 80s and 90s and stay there for a long time. This would have popped a long time ago. Government keeps stimulating, keeps upping the stimulus. Again, this 27 trillion. If anybody, any economist or any forecaster in the early to mid 90s had told you that we're going to have a big slowdown and the U.S. government would print $27 trillion out of thin air to fight it, people would have thought, oh, that'll never happen. Okay, that's how crazy this is. So a bubble happens when financial assets start to go up much faster than the economy would warrant, because they're just thinking it's going to get better and better, and we've reached this permanent plateau of prosperity that Irving Fisher quoted in 1929. He quoted that right as the stock market was about to peak. Okay, that's what asset prices and the economy being good. People get delusional when they don't get their ASS kick once in a while. Then you get a crash and you get a deflation to bring things, asset prices back down to reality. And that's painful when people are losing that much money. Banks are failing. They lend against all those houses and buildings. People lose money in their stock portfolios and then they spend less money. Oh my gosh, I got to work. You know, it causes this whole tumble down effect where one thing just makes the other worse. The worst bubble and downturn took 34 months from the top of the stock market to the bottom to crash. 89% unemployment went to 25% on a lag to that. That was the worst downturn, and that's as long as it took. So I'm saying if we're getting ready to peak here or soon, this downturn will take us probably into late 2026 to mid 2027. It's going to take at least 2 years. It may happen a little faster this time because it's been stretched so hard. The downturn starts soon and it ends 2 to 3 years from now. I'd say the stock market could have peaked in July here, by the way. Real estate will tend to peak on a bit of a lag. Things should be falling the strongest in 2025, if I'm correct. And then they'll continue to kind of staircase down into at least late 2026 and probably into early to mid 2027. It just depends on how fast it goes. More people, more infrastructures. And generally, the cost of living goes up. The real reason is we're always delegating more and more of the tax. I mean, you delegate and everything goes up, but you're specializing in what you do. So you may be making 3 times the income, but by delegating, everything may cost you twice as much. There's always inflation. Expanding new young people entering the workforce means you have to pay for those offices and infrastructures and training up front. And you get the benefit from that new worker getting more productive over decades, okay? So inflation always will happen, and it happens mostly when new people are entering the workforce. And that's why the biggest entry of new workers in the workforce was from the late 60s into 1980, and that's when we had the highest inflation. It had nothing to do with government deficit. They blamed it on government deficits back then, which was 90% wrong. The average person also can't pay $1 million for a damn teepee, okay? $400,000 for an average house in Ohio that was $100,000 just 20 some years ago. That's something somebody has to pay for, the interest and the mortgage for the same house. Inflation has probably doubled in this period, but overall this bubble's gone up 4x. Financial assets like real estate would have to come down 50% just to be in line with inflation. How do elections work? You know what decides elections? A tiny percentage of it, the swing vote, 10, 20% at most. It's the same in economics too. Everybody can be doing everything normal and they're not going to change. It only takes 5% of people to just become all of a sudden net sellers or to get price out of the market. And then that starts it. And then the more prices go down, the more they go down. So that's the thing people don't miss. Yes, most people are not going to cause or trigger this crash. It doesn't take a lot of people, but people have to eventually sell these houses, whether they die or trade up to another one. And at some point, price alone will erase a bubble. There's no bubble ever in history that has gone up forever and not crash, and no bubble that's gone up a lot hasn't crashed a lot. That's all I know. This may be the first one, and you and many people I talk to have theories of why this one will be permanent plateau. I'm telling you, I wouldn't bet 1 penny on a dollar on that scenario. Not even 1 cent for 10x returns. Let me tell you something else that can cause a crash. A crash happens somewhere else. Can you think of some tiny little country over in Asia? China. that has a real estate bubble, it's already starting to preaching this forever.
Yeah.
That bubble makes ours look like peanuts. When you see depressions in history, they follow major bubbles. When you see deep recessions, that just follows a boom. Recessions follow ordinary overexpansion of businesses and consumers and booms. It is depressions that follow bubbles because of the financial asset contraction that just makes it way worse. Can anybody tell you how much financial assets there are in the world now and how much there should be?
Right.
630 trillion, it's 6 times GDP, and normal would be 2 times GDP at 200 trillion. In other words, we have about 3 minimum, 400 trillion overvaluation in financial assets, which cost everybody money. Now, if you can keep borrowing against that and they keep going up, yes, you can keep this thing going a long time, but at some point you can't have a house cost so much that even a strong upper middle class person cannot afford it. I focus on Bitcoin for one reason, that the whole crypto sector, not just Bitcoin, it's set to restructure all the financial assets on a global basis, and Bitcoin will end up being the digital gold, but that's decades from now. But crypto itself is one of the next big things, particularly in financial services. So this is real, and Bitcoin is in its baby bubble. I actually compared Bitcoin to the leader in the dot-com bubble just 22 years before it, Amazon. And they're almost identical. Amazon went from $6 to 136 in the baby bubble, just like Bitcoin just went from nothing to 73,000, and then it crashed all the way back to $6 in 2002 tech bubble crash. So that first bubble was the first tech bubble. We just saw the second tech bubble, and this is part of a 45-year cycle I track, every 22 years, 22 and a half approximately. So there's some method to this matter. And that bubble is bursting. The difference is the government is extending this bubble and won't let it burst because they know when a bubble bursts, you get a depression, not a recession. And no politician, no Federal Reserve chairman wants to be in power when that happens. This bubble at some point has to burst. The trillion-dollar question that you keep asking is when. I think now, only because they went into such extremes in bailing out COVID that they created that 9% sudden inflation, and they had to tighten hard, and they did, and we have not felt that yet. We're going to feel that the first quarter of next year, so about 6 months from now. That's when I'll be able to look at my newsletter subscribers and say, I think it's going to be much harder than people think by then, but here's how much the tightening hit, because they went straight from stimulus to tightening. That's never happened in history before either. So the stimulus hasn't even worn off and they're tightening. I just warn people, be safe here. Stocks may look like they're going to keep going up. They could go down anytime. The first crash out of every bubble in history has been 40%, typically in a matter of 6 months or less, okay? So this thing could happen so hard that by the time you realize it's a crash and not a correction, you're already too far into it. I say this good time to be out of stocks generally, out of real estate you don't really need, especially speculative real estate, and see if this thing sets in, because I think it's going to set in. I think 2025 is going to be the worst year we see in our lifetime.